Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investors International Limited. And here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. A little simpler here compared to the Chicago contract, at least superficially. Instead of four, we have only two significant recent patterns. Firstly, a head and shoulders pattern for the late October 2021 to start of 2022 period with a neckline currently at 790 that this week has been the base of the market's attempt higher. This head and shoulders pattern still has not resolved itself into whether it's a head and shoulders top or a head and shoulders continuation pattern. However, I would note that the rise 2 weeks ago did not manage to even reach the top of the right shoulder, which is significant. The second pattern is still ongoing. It is the late November to date bear channel, currently 720 to 839. It looks quite wide, but it also does look reasonable, especially after rejection 2 weeks ago from the November 2021 to date downtrend, currently at 839. Interestingly, the lower bull channel line, currently at 720, was formed by the rejection back up 4 weeks ago from the combination of the June 2014 high at 748 and the extension of the neckline, currently at 750, of the small reverse head and shoulders pattern formed over late August to September last year. This neckline and the lower bull channel line are ones to watch, as prices didn't even manage to reach the ever so slowly rising long moving average below, currently at 733, before turning back up. Hence, an overall view would suggest this market is a tad more bearish in outlook than Chicago wheat. With that in mind, I have decided, just for the moment at least, to place a potential target X below as an initial target for the head and shoulders pattern. This assumes a lot, namely that this is a topping head and shoulders pattern and not a bullish continuation. Thus, target X would potentially be in the 731 area. Now, this ties in with the target being around the long moving average. Additionally, keep a close eye on the medium moving average, currently at 796, thus just below the current market. I suspect this moving average and a declining short medium moving average that's a little above, currently at 807, may be the key to some possible new action. Minneapolis wheat. Well, after last week's retiring the brilliant and supremely important December 2020 to early April 2021 bullish Andrews pitchfork, I now find that due to the market's action of moving higher, I will have to retire at the very least two new bearish patterns that I've only recently drawn. These are the bearish Andrews pitchfork for the late December 2021 to late January 2022 action. This was the first bearish pitchfork I had drawn since April of last year, plus the mid-December 2021 downtrend, currently at 916. Both have been thoroughly trashed. Now, I did say last week, as the market was getting squashed between the long moving average, currently 905, and a declining upper time, currently 878, that something would have to give here, and soon. I added, and I quote, "I'm not wedded to this bearish shift pitchfork. I'm quite happy to morph it into a bearish Andrews pitchfork. I'm happy to morph it into a bearish shift pitchfork, or even retire it completely. But for now, it still works, just about. Well, it doesn't work anymore, and it'll be gone after this commentary, as will the downtrend." The key takeaway from this has been the strength of the long moving average. The long moving average has been tested 3 times since mid-January, and whilst having been breached, has still not been broken. Indeed, its actions have prompted me to draw a new uptrend since mid-January based around this moving average, and that's currently at 906. I've also drawn a connecting trend line between the highs of this year so far, currently at 976. Thus, whilst it is very early as yet, we could have a possible rising wedge pattern developing here. However, treat this with a pinch of salt, as you can clearly see by yesterday's action that there is some significant resistance nearby overhead. Now, this consists of the medium moving average, currently 973, the short medium moving average, currently 967, the 50% Fibonacci line of November 2021 to January 2022 move at 969, and various congestion points in the band between 974 and 986. These overhead resistances cause the combined bearish harami and possible shooting star pattern type 1 bearish seen yesterday, though the market seems to have a short memory as prices are slowly moving higher again today. These two forces, the fairly immobile overhead resistance and the slowly rising long moving average and associated uptrend, are starting to squash or squish this market, if you like. Finally, there is one other pattern I'd like to discuss. I've done this one already, but I want to go a little bit more into it, and that is one that I have not labeled as yet. It is a large pattern, but it is also shallow. It is a look at the whole action since mid-July 2021 as a possible head and shoulders top. It is a stretch, but well, I might explore this idea further. But given the recent current attempts higher, I don't think it's worthwhile as yet. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.